This is a lecture from Open Tuition. For the free lecture notes that go with this podcast, please visit opentuition.com.
Page 3, the concepts behind corporate governance. Honesty. When we're going through this list here, just think, it may or may not be embarrassing for you to be thinking about applying this to yourselves, but just think about it being applied to other organisations within this country that you do know. Just think about it. Honesty, not simply telling the truth, but also not being guilty of issuing misleading statements or presenting information in a confusing or distorted way, the way I just did with my earlier example. Accountability. There's an emphasis of the director's accountability to shareholders, but it does open the door for discussion about the extent of accountability to everybody. And certainly directors and companies have a direct responsibility to their shareholders, primarily to increase shareholder wealth, and therefore, or in doing so, by increasing the wealth of the company, and thereby shareholder wealth is itself improved. But they also have an accountability to everyone else, to increase shareholder wealth, but fairly, not at the expense or to the detriment of any other particular group of stakeholders. Independence. There's a strong emphasis on the appointment of independent non-executive directors. NEDs. From now on they will be called NEDs. NEDs. NEDs should be independent of the company. There should be no relationship between a non-executive director and the company, other than the relationship that they are non-executive directors. And we'll be looking in greater detail at the characteristics, the ideal characteristics of non-executive directors, but they should have an independent attitude of mind. They should not be closely involved with the company in terms of day-to-day transactions. These are not people who turn up on a daily basis to help run the company. They're people who attend on a regular but not frequent basis in order to oversee and supervise and control the activities of the day-to-day directors, the executive board. So independence is a big issue. Responsibilities. A system of responsibility should exist where directors acknowledge their responsibilities to the stakeholders. They take corrective action where necessary in order to keep the entity focused. There is this responsibility. It's tied in with accountability. Decision-taking, judgments. This is the skill with which management make decisions. And the more skillful the management, hopefully then, the greater the chances of the company improving its wealth. Something I've never thought of before, and it's only just struck me now. If a company improves its wealth, does that not automatically mean that somebody else is losing? If I take money from you, then you've given money to me, and that means that you're not in as good a position. Maybe you see it as an investment for the long term on the basis that if, when you do pass these exams, then you'll get your repayment on your investment. No, I don't know. This calculator, improving the company's wealth. But at the same time, have we not taken things from the people who made the calculator? Have we not taken the resource from the threatened rainforests of Southeast Asia or the Amazon jungle? Are we not therefore destroying the planet? Hello? Reputation. Reputation is built by directors. The reputation of a company is surely directly dependent upon the reputation of the directors, their fairness, their ethics, their morals. And the reputation of the company is one of the elements of corporate governance. The directors should strive. The directors should make every effort to improve the reputation of the company. And you're only going to do that, you will only do that, if the directors themselves are people of good repute. Integrity, straightforward dealing, honesty, balance, striking a balance between the different interests of the different classes of stakeholder. And for financial statements themselves to have the characteristic of integrity, clearly this has got to depend upon the integrity of the people who prepare those financial statements and the integrity of the people who audit those financial statements. And if your auditors are people of integrity, as I'm sure all of your firms are, if your auditors are people of integrity, then it means that the financial statements themselves will be financial statements which demonstrate this characteristic of integrity. And people can then rely on them better. People can then look at financial statements and make decisions with reference to those financial statements. The tax authorities can better rely on the figures. The government, for their statistics, can better rely on the financial statements if we're happy that the financial statements have been prepared by people of integrity. Integrity involves a person who demonstrates high moral character, is principled, professional, honest, and trustworthy. Fairness takes into account the interest, rights and views of everyone who has a legitimate interest. We may have a problem there in determining who has a legitimate interest. Clearly the directors do, clearly the shareholders do, and the employees do. But what about customers and suppliers? What about the families of the customers and suppliers? And what about the local shops who sell their goods to the customers and suppliers and the families of the customers and suppliers? And it just extends outwards, and it's like throwing a stone into a river, and the ripples just go out and out and out, accelerating in size as they go further away. And finally, transparency and openness involves full disclosure of material matters which could influence the decisions of stakeholders. Not simply openness in the reporting of information required by IFRS just because it is required by IFRS. It's other information as well, like cash and management forecasts, environmental reports and sustainability reports. And we'll be talking about the environment and sustainability at greater length. That list you've got, these corporate governance concepts, I tried when I was writing these notes, I tried to where there was a list of things to remember, I tried to put them in a sequence that you could remember easily. And you've got here the mnemonic hair drift. Hair drift, honesty, accountability, independence, responsibility, decision-making, reputation, integrity, fairness, transparency. Hair drift. It's what happened to my hair. It just drifted away. You women are rather more fortunate, on the basis that presumably you're not going to go bald. You're not planning to, are you? No. No, I didn't plan to either. So hair drift, and we'll be coming back to hair drift on a number of occasions within the next 2 days, so it will be worth remembering it. Corporate governance and agency theory, page 4. What's happened there? Corporate governance and agency theory. Directors act as agents of the shareholders. They act as agents of the company, but the company is represented by shareholders. So the principal is the company, the agent are the directors, and the acts of an agent bind the principal. And that's why when directors enter into the contract on behalf of the company is then bound to honour that contract. And corporate governance tries to ensure that these agency responsibilities are fulfilled by these agents, by the directors, by requiring disclosure and suggesting performance-related rewards. And again, we're going to come into performance-related rewards and remuneration of directors at greater length. There's a definition there of an agency relationship. Just read the definition there. It's a contract under which one or more persons, the principals, that's the company in our situation, engage another person, the agent, the directors, to perform some service on their behalf involving delegating decision-making authority to the agent. Clearly a company can't itself enter into a contract because the company is artificial. So they delegate the authority to the directors, and the directors then exercise this delegated authority. Fiduciary duties definition. Fiduciary comes from the Latin word fides, meaning faith. So it's a duty of good faith that the directors owe. It's also a duty which is remunerated. Fiduciary duties definition, therefore, is a duty imposed on certain people because of the position of trust and confidence in which they stand in relation to another. If you ever look at a coin, I don't know if it still has it, a UK coin, there's some writing on the back of the coin, and on the front, but some writing on the back. Elizabeth II, Elizabeth II, and then it says, or Elizabeth R, I think it says, which is the Latin abbreviation for the word Queen. And then it also says Ind Imp, or used to, Ind Imp, which was the Indian emperor, the empress of India, because that's when the UK had India under its control. And then it also says FD, Fidelis Defensis, defender of the faith. So, Fidelis is faith, it's a duty of good faith. It's a position of trust and confidence in which they stand in relation to one another. It's more onus than generally arises under contract or tort. What's tort? Do you remember tort from your law days? Did you do law? Yeah, do you remember tort? Yes, of course you did. Elsa, did you do law? You did, didn't you? Yeah, and you did. So there's no need for me to remind you what tort is then, is there?
Civil wrong.
Yeah, it's something wrong, isn't it? But it's not the same as contract. It's the omission or the doing of something, or the omission to do something which you are required to do but not required by contract or by law. So you're doing something, it's a wrongful act or omission is what a tort is. So the duty is more onerous than generally arises under contract or tort. It requires full disclosure of information held by the agent, a strict duty to account for any profits received as a result of the relationship, and a duty to avoid conflicts of interest. Within the concept of the law of agency, agents shall not make secret profits out of their position as being an agent. Directors shouldn't receive benefits and bribes just because they happen to be a director. Directors should not abuse their authority. They shouldn't take advantage of a corporate opportunity where the opportunity fairly and correctly belongs to the company. Why should the director derive personal benefit other than their remuneration simply by taking over a contract which rightly belongs to the company? Fiduciary duties are owed to the company, not to individual shareholders. So if I had a fiduciary duty to you via Finance Limited, if I had a fiduciary to you, it doesn't mean I have a fiduciary duty to you, nor any of you. But my duty is to all of you as a group, as a single unit. That's where my duty lies, not to any individual. And then finally, directors must exercise their power for the proper purpose. And this is written into statute. This is now written into English company law, that directors have got to exercise their power for a proper purpose. Page 5, the duties of directors to perform. If they're paid, then they have a contractual obligation to perform. If they're not paid, then there's no such obligation. They have this duty in contract to perform. Obedience. Act strictly within the boundaries, within the confines of the instructions given by the company. Do not, therefore, exceed your authority. Don't be guilty of stepping over the line which is the limit of your authority. There's a Latin expression for that, isn't it? The Latin expression of ultra vires, beyond their powers. Directors should not act beyond their powers. Skill and care. Should act with such a degree of skill and care as may reasonably be expected from a person of that age, experience and qualification. Age is missed off the notes, but it should be in there. If you have a young director, then clearly they're not that much experienced, and therefore you cannot expect them to demonstrate such a degree of experience that you could not expect from a person of such tender years. Personal performance. We can delegate, directors can delegate, but they can only delegate assignments which have been given to them on the basis that the person to whom they delegate, the director has no reason to believe that that person is not capable. Now, I'm feeling not very well this morning, so what I'll do is I'm going to ask Agnesa to take over. I'll delegate my authority to Agnesa, and I'm just going to lie down at the back of the room. I am entitled to delegate, but I can only do so on the basis that I have no reason to believe that Agnesa is not capable. I can delegate, for instance, I could delegate auditing lectures to the auditing lecture that Ken uses, that John uses, because I have every reason to believe he's competent. But I couldn't delegate auditing lectures to John because I have every reason to believe he's not competent in auditing, competent in lots of other subjects, but not auditing, not law. So, yes, directors are entitled to delegate. It is within their authority to delegate. It's what is expected that they will delegate, but only on the basis that the person to whom they delegate, what's that person called? He's called a delegate. So it's the same spelling, it's just a little bit of a different pronunciation. The verb is delegate, and the person to whom you do delegate is then a delegate, a delegate. Sometimes it's known as the delegatee. So I can delegate, so long as I have every reason to believe. I should avoid conflicts of interest. This again is written within English statute. Shouldn't sell your own property to the company. Even though, this is fascinating, even though that property has been independently valued by an independent expert, if I have property and I want to sell it to my company, I shouldn't. I shouldn't do it, even though it has been independently valued, because I'm not being seen to be independent. Some aggrieved shareholder is going to say, where did the company get this property from? And I'll say, well, it was actually mine and I sold it to the company. Surely the instant reaction of anyone is going to be, oh, and I bet you sold it at a good price to yourself, so you made a substantial profit for yourself. So directors should not be guilty of selling their own property to the company, nor of buying property from the company. Think about that. You as a director have just bought this major asset from the company. Why? Probably because you thought it was a good deal, and therefore you're doing it for your own benefit. And if it's a good deal for you, and if you think that that property is going to increase in value, surely the increase in value should belong to the company, not to you. So why would a director buy anything from the company? Why would a director sell their own property to the company unless it was advantageous for the director? And if it's advantageous for the director, it must be disadvantageous for the company. And so we have a conflict of interest. Confidence. Agents should not disclose confidential matters about the principal, even after you have left. Even after you're no longer employed, you've retired, you've left maybe under a cloud, you've been maybe made redundant, you've been sacked, you just decided to move on and go somewhere else. All the confidential information that you possess or did gain as a result of being a director, agent, that should remain confidential. Which is interesting again, because then you face the prospect of, for instance, I'll use the auditing profession. If a partner were to leave an audit firm, do you think it would be ethical for that partner to set up his own firm and write to all his clients from the previous firm? Is that ethical? No. And does it happen? No. Accounting for benefits, agents must account to the principal for any undisclosed benefit. If a director does, as a result of his position as an agent, if they derive a personal benefit simply because they happen to be a director of the company, then that benefit should be accounted for and paid over to the company. Why should a person benefit personally as a result of his use of the company's assets? And the answer is he shouldn't. So if he does derive a benefit just because he's a director, then he should account for that profit, that benefit which he has achieved. We'll be looking at those in greater detail when we start looking at the statutory duties of directors. Next page, page 6. Oh, sorry, I've not finished page 5. Because ownership of an entity is necessarily separated from management, there may be problems, and these are the problems. Ownership and direction are, in big companies, typically separate exercises. In a smaller company, it would not be unusual to find that the directors were also the major, if not the only, shareholders. So ownership and management in a small company are often very closely linked. But when you start looking at big companies, when you start looking at really the target for the principles of corporate governance, then we have this distinction between those who are interested in the success or failure, the shareholders, and those who are responsible for the direction and control, the directors. So we have these potential problems on page 6. Directors may choose to pursue strategies which are more beneficial for the directors than for the entity. How? What? Example? Well, it's not unusual for directors to be given a bonus based on current results. And in order to improve current results, can you see that a board of directors may reach a strategic decision that says, let's not invest in development of new products, because if we do, then we're spending a lot of money. Although we're keeping the expense off the income statement because it's going to be capitalized as development expense, because it's being kept off the income statement, then the short-term profits will be improved and increased. And if we do that, then we're then in line for a better bonus, because the bonus is based on this year's profits. Equally, they could say, let's not invest in development expenditure, let's just not develop, let's not just develop any new products. But that way, although the short-term cash position is strengthened, because we're not spending money on what is potentially going to be a white elephant, it does mean that we don't have new products for the future. So 5 years down the line, we've been overtaken by competition, and we're beginning to lose market share, and reputation disappears. But it doesn't matter for the directors, because they've not been spending the money, therefore there are more funds available, therefore in the short term they're going to get better returns themselves, better personal returns. So the strategic decisions need to be made by directors for the benefit of the company, and the next few words are important, looking at the long term. Looking at the long term. There should be a long-termism approach to directors and their actions and their strategies. A long-termism. Short-termism tends to lead to disaster. So a conflict of interest will necessarily exist, because directors are people, they're humans, they have human needs, wants, they do want their salaries, they want their excessive remuneration in order that they can improve their own personal quality of life. But on the other hand, that can easily be seen to be rather against the interests of the company. Directors will almost certainly have a different attitude to risk and risk management, because it's not their money that they're gambling with. You put a director into a situation where there are funds available, because it's not my money, I will quite happily take a risky gamble. But that may not necessarily be in the best interest of the company. But because it's not my money, I have a greater risk appetite. That's not necessarily good for the company. If management has only a small beneficial interest in the company, or even none at all, then they could very well pursue short-term results, improving current bonuses, to the exclusion of far more far-sighted strategies which would be of greater benefit. Ultimately, shareholders have the right to decide who shall, and therefore who shall not, be directors of their company. Ultimately, what a wonderful idea that is, that shareholders will decide who are the directors, who shall be the directors. It works brilliantly in theory. In practice, I'm going to suggest to you it's not them at all. Who is it that decides who's going to be directors? Who is it? Ultimately, the shareholders have to give their approval. But shareholders don't have the cohesion. They don't have the dynamism. They don't have the organization, typically, to act as a concerted group. So they will each pursue their own individual ideals rather than acting together as a single unit. Which group of people do act together as a single unit? No? No? No one? Anyone?
The board.
All this? Yeah, the board. The directors do. The directors act as a single unit. And it's they, in practice, who appoint other directors. These new appointees, we three, could appoint any of the others of you, because we've decided that any of you that we want to appoint is a suitable person to serve on our board. So we three, by board resolution, could appoint the fourth one, for instance, but that appointment has to be approved by the shareholders. But the shareholders don't have the dynamism to act together. So it will normally be the case. I don't think I've ever heard of a person being appointed by the directors, then being refused by the shareholders. In theory, they can, but it doesn't happen in practice. So generally, shareholders have neither the dynamism nor the organization to effect such a change in the composition of the board. It doesn't happen. Overcoming the problem, called alignment of interests or goal congruence, we can provide incentives to ensure that the interests of the directors are in line with our own interests. And the incentives include profit-related pay. It does actually say within the combined code that an element of directors' remuneration should be performance-related. But a better way of performance relating, rather than profit-related pay, would be to have share issue schemes or share option schemes, long-term into the future. Give the directors millions of options where they're entitled at some time in the future to buy shares at a specified price. So if our share price today was $3, give the directors millions of options where they would be allowed in 6 years' time to buy these million shares at a price of, say, $6. What are you going to do in the next 6 years if you were a director? You'd really work hard in the interests of the company to drive up the company worth, to drive up the company's share price till it exceeded $6, and then you'd spend your $6 buying all these shares cheaply, because then you can sell them and you've given yourself this incentive to work hard. Now, why would you, as shareholders, give me options to buy your company shares at some time in the future at a price of, say, $6? Well, because you're sitting there with an investment at the moment which is only worth $3, and you're saying to me, if you can double the value of my investment in 6 years, then I'm happy. It does mean that you're improved your own wealth. Don't worry, it's just money. Share option schemes then, just looked at those. But for all of these, there's a natural tendency for management to adopt creative accounting. If I can improve the apparent wealth of the company, then the share price will go up and then my options become viable. It becomes attractive for me to exercise the option. But by driving the share price up, it may be that I'm tempted to indulge in this creative accounting. It may be that I will keep things off the balance sheet, off the statement of financial position. It may be that I enter into some contracts which are of questionable provenance, questionable acceptability. But by doing that, the apparent wealth of the company has improved, therefore the share price will improve. Pushing it above my $6, then I can exercise my options. So there still will remain a conflict of interest. I don't know if it's just me, but when you start going through this paper, you develop a degree of cynicism. You become cynical. Or maybe it is just me. Maybe all of you too nice to become cynical, but I find I do. Some of it I believe in. Some of this stuff I can believe in. And some of it I could very easily not believe in. And this honesty, integrity, accountability, responsibility, yeah, you can't argue that that's got to be good. But on the other hand, it doesn't come down to general principles, does it? It comes down to you, the person. And it comes down to you, the individual, who's been put into this position where you have authority, and therefore you have the opportunity to abuse that authority. And the cynical me thinks that people possibly do abuse that authority. What was that mnemonic that we had, the elements of corporate governance? What was the mnemonic? Hairdrift. And what did it stand for?
Honesty.
What did it stand for?
Honesty.
Honesty. What's another word for honesty?
Integrity.
Probity, yeah, probity. Believability is probity. So that's the H. What's the A?
Accountability.
Accountability. I? Independence. Yeah, independence. R?
Responsibility.
Responsibility. D? Come on, make your decision, make your decision. Who?
Decision.
The decision making, yeah, decision. R? What John has a good one of?
Reputation.
Reputation. I? What I am a person of integrity. Into F, think of the colour of, that's as her fairness. T, through the window. How would you describe a window? Transparency, yeah, transparency. So hairdrift.